Hi, my name is Richard Brown from Abound Paraplanning. Welcome to today's video. For all those that have sent me comments relating to other videos, thank you very much. Your thoughts are appreciated and comments appreciated as well. Today's video is on cash flow and budgeting and balance sheet analysis. Just a few tips around that. These three items, cash flow in particular, should form the core of what financial planners do. However, I think in a lot of cases we spend far too much time just discussing investments and performance rather than really analysing our clients' cash flow and helping them to actually achieve the goals that they're looking to achieve. Now, the first thing I'd like to talk about is the actual cash flow preparation itself. As financial planners, it's mandatory that in a comprehensive advice we do look at the cash flow of a client. Haven't seen too many times where this has come in as negative, which is quite surprising really, because we often see lots of other miscellaneous debt, as I'll refer to it, sitting around. Not only do we have often a mortgage, but we'll have credit card debt, we'll have store card debt, and we might have hire purchase as well. And this usually is representative of what is actually happening in the cash flow, not what we present on the paper. Now, as a financial planner, we should really be advising our clients on how to better manage their cash flow. This should form the basis of any financial plan, not just a discussion around their superannuation investments or other, but around their cash flow, to actually help your client achieve their goals. Now, this is only a suggestion. I've used it myself, and we recommend clients do this. But you can't make clients do this, but you can offer some suggestions. And what we do is we use a CMT account as the hub, and that's where the salaries come into. And we use two separate debit cards, not credit cards, debit cards, separately for each of the main breadwinners in the household. One is for ongoing maintenance of the household in terms of food, clothing and everything, and the other is for spending money for the other spouse that doesn't manage that process. Now, these amounts go in each week and no further funds are drawn on until the following week. This puts a little bit more conscious spending around individuals to know that they haven't got any other funds coming through until the following Monday or whichever day that suits. We have found this to be very successful in limiting people from overspending. It's just a little tip. But if you can get your clients to get into some different sort of habits rather than put everything on credit, to actually spend what's in the account and to manage that from week to week, often we've found that clients have commented that they've actually put off that discretional spend until the following week, or until they build up a few $100s extra in their personal accounts. Just a little tip. The next tip that I'd like to share with you is that rather than go back and do detailed cash flows for clients from period to period on what they've spent and what they haven't spent, what I've found much simpler and adds a lot more value, because people don't like you to delve too much into their day-to-day activities, is to actually measure their statement of position or balance sheet from one period to the next. That might be a year, 6 months, depending on the level of service you want to offer your client. And what I've found is if you actually get a proper balance sheet or statement of position at the starting period, now we put the house in at a value, let's assume there is a house there, and you'll leave that at the same value from period to period. But everything else, you'll actually have a factual, up-to-date number. And that would be with mortgages, with credit card debt, hire purchase debt, value of investments, value of super, the most common ones. And what you'll do is track, by doing a balance sheet from period to period, you're able to track exactly where the spending's going. And it's very satisfying to go back to a client and say, listen, from this period to this period, we've actually increased our super balance by $8,000, we've reduced our debt by $14,000, we've paid off those miscellaneous credit cards over the last 12 months because we've employed that cash flow planning that we discussed, and you're actually $32,000 better off from period to period. When clients can see some results in black and white like that, they tend to embrace the financial planning process a lot more. And for you as the advisor, you end up with a sticky client, someone that's actually getting value from your services. So if I can offer one little bit of advice there, it is not just about the investments, it's about the cash flow planning and about measuring statement of position between periods that really offers value to your clients. I hope you got something out of today's video. My name is Richard Brown from Abound Paraplanning. Thanks for joining in, and I look forward to catching up with you soon. Thank you.